Ego feels very good until we face its consequences. There is a very thin line between self confidence and ego. Self confidence is necessary to grow in every space of life, but maintaining this fine line between ego and self confidence is very important, not just in stock market but also in your life, as it affects your decision making, and decision making plays almost 99% role in your life. There is also a saying, you are your own decisions. Before we dive into how ego affects your decisions, let's first define what we mean by ego in the context of stock market. Ego in simple terms refers to the sense of self-importance and the desire to be right. It is that voice inside your heads that wants to prove itself and seeks validation in our investment choices. While confidence is a good trait in investing, an unchecked ego can lead to unwanted consequences. One of the most common ways ego manifests itself in the stock market is through the overconfidence bias. This bias occurs when investors believe their abilities and judgments are better than they actually are. They tend to underestimate risk and overestimate potential returns, leading to bad investment decisions. Another aspect of ego in the stock market is the fear of missing out or FOMO. This phenomenon arises when investors see others making significant gains on certain stocks and they don't want to be left out. Consequently, they may rush into investments without proper research, solely driven by fear of missing out on potential profits. Our ego can also cloud our judgment when it comes to holding on to losing positions. Admitting that we made wrong decisions can be challenging for our egos. As a result, some investors hold on to losing stocks, hoping they'll eventually turn around even if the evidence suggests otherwise. Ego driven emotional trading is common issue in the stock market. When our investments perform well, we may feel sense of invincibility, and that can lead to making impulsive decisions based on emotions rather than rational analysis. The good news is that we can learn to manage our egos and become better investors as well as humans. Cultivating humility is key. Instead of chasing quick gains, focus on learning the right things and acknowledge that even seasoned investors make mistakes. The stock market is a place of learning and adaptation. You don't have to be right all the time here. Two effective strategies to encounter the negative impact of ego in the stock market are diversification and long term thinking. In the beginning, diversifying your investments across various stocks can help reduce risk. Additionally, adopting a long term perspective, not 5 or 10-year long term, but at least 1 year perspective, help you avoid impulsive and regrettable reactions to short term fluctuations. Recognizing and managing our egos is essential to be successful in stock market. Stay humble, stay informed, and always know what you are doing before making investment decisions. Think in terms of different possibilities. Embrace the learning process and understand that the stock market is a journey of growth and improvement and adaptation. One egoistic decision can wipe you out. Stay egoistic at the cost of consequences.